I spent 3 weeks reading Reddit threads about which index fund to buy at Fidelity. And the funny part is that 90% of the people arguing on those threads are wrong about the same thing. Not wrong about the math, wrong about which question they should be asking. If you opened a Fidelity account this year, Googled Best Fidelity Index Fund, and walked away more confused than when you started, I keep seeing this exact pattern, and I want to clear it up in the next 8 minutes. Here's what we know. Over 15-year periods, more than 90% of professional large-cap fund managers fail to beat the S&P 500. That is from S&P Dow Jones Indices SPIVA report. Warren Buffett bet a hedge fund firm $1 million in 2007 that a plain index fund would beat their best picks over 10 years. He won that bet in 2017. So whatever fund you pick, the strategy itself has already won, which means the question for you is not which fund is best, it is which fund fits my account. Those are different questions, and almost nobody on the internet answers the second one. Here is what's at stake before we get into the tickers, because the why determines whether you bother. The S&P 500 has averaged roughly 10% per year since 1957. $1,000 left alone at 10% for 20 years becomes $6,727.50. $6,000 per year, contributed for 35 years, can plausibly cross $1 million depending on the period. And going back to 1926, there has not been a single 20-year stretch where the S&P 500 ended in the red. That is not a guarantee about the future. It is a track record about the past. The biggest risk for most viewers right now is not picking the wrong index fund. It is picking no index fund and waiting another year while compounding does its thing without you. So before we get to the verdict, I want to diffuse something. I see people on Reddit arguing for 30 comments straight about whether a 0.03% expense ratio is meaningfully better than 0.04%. Here is the math. 1 basis point, that is 1/100th of 1%, on $10,000 is $1 per year. If two funds differ by 1 basis point, you are arguing about $1. The Investment Company Institute's 2025 data shows the average actively managed equity fund charges 0.40%. The average index fund charges 0.05%. That gap, 35 basis points, is the gap that matters. That is $35 per year per $10,000, compounding for decades. The gap between the index funds we're about to discuss is rounding error. So if you have been frozen choosing between two index funds, you have been optimizing the wrong decimal place. The first reason to pick a fund is, can I actually buy and hold this without thinking about it? Everything else is noise. Now, what about total market versus the S&P 500? The S&P 500 is 500 large-cap U.S. companies, market cap weighted. A total market fund holds those same 500 plus thousands of smaller ones. People online will tell you the total market fund is more diversified and therefore safer. Here's the part that surprised me when I looked at the data. As of April 29, 2026, the information technology sector alone was 34.21% of the S&P 500. So when you buy the S&P, roughly a third of your money is sitting in tech. The total market funds aren't dramatically less concentrated in tech either, because the index is weighted by size. So diversification between an S&P fund and a total market fund is real, but it is smaller than the marketing makes it sound. You might be thinking, well then which one wins? Honestly, look at the last decade. Large caps led, and an S&P fund slightly outperformed a total market fund over that stretch. Other periods, small and mid caps led, and total market won. Across very long stretches, the gap between the two is small enough that most investors will not notice it on their statement. So pick one, hold it forever, and stop checking which Reddit thread agrees with you this week. Which brings us to the actual question. You have a Fidelity account. What do you buy? The answer splits in two, and almost nobody splits it correctly. If you are buying inside a Roth IRA, a traditional IRA, or a 401k rollover at Fidelity, basically a tax-advantaged account, the right pick for you is FZROX or FNILX. FZROX is Fidelity's total market fund, launched in 2018 with a 0.00% expense ratio and no minimum. FNILX is Fidelity's large cap fund, also launched in 2018, also at 0%, designed to mirror U.S. large cap performance very similar to the S&P 500, though it does not officially track the index. 0. Free. They are genuinely free to own. In a Roth IRA you plan to keep at Fidelity for 30 years, that is the right answer. But if you are buying inside a regular taxable brokerage account at Fidelity, the right pick is VTI, Vanguard Total Stock Market ETF. 0.03% expense ratio, trading at $354.18 per share as of May 1st. And the reason the right answer flips by account type is one of the most important things nobody is telling you, so stay with me here. Picture this, it's 3 years from now. You have $80,000 in FZROX inside a Fidelity taxable brokerage account. And Fidelity does something that annoys you, service issue, fee change, a new platform you hate. You decide to move your account to Schwab or to Vanguard. Here is what you find out. FZROX is Fidelity proprietary. It cannot be transferred to another brokerage, not because of a fee, because the fund only exists inside Fidelity's system. To leave, you have to sell. And the moment you sell in a taxable account, you owe capital gains tax on every dollar of growth. That fund you own to save 0.03% in fees? Forced liquidation could cost you several $1,000s in taxes on a single move. In a tax-advantaged account, that risk vanishes because selling inside a Roth or traditional IRA does not trigger capital gains. In a taxable account, the supposedly free fund has a trapdoor. You might be thinking, but I'll never switch brokers, so I'll just take the zero fee. Maybe. People said that about a lot of brokerages that no longer exist or that they no longer like. The reason VTI is the right pick for taxable is that VTI is an ETF, and ETFs use a mechanism called in-kind redemption that mutual funds don't. In-kind redemption lets the fund swap shares with big institutions instead of selling stocks, which means VTI distributes far fewer capital gains to you each year. That is a tax efficiency you keep every year you own it, on top of the fact that VTI is portable to any brokerage in the country. And one related correction on Vanguard's ETF rules, because I see this one online a lot, Vanguard's patented conversion process goes mutual fund to ETF, not the other way. You can convert VTSAX to VTI tax-free, but you cannot convert VTI back to VTSX. So if you ever buy the ETF, you've made a decision that is harder to reverse. So the rule for Fidelity holders is simpler than most videos make it. Tax-advantaged account at Fidelity, FZROX or FNILX, depending on whether you want total market or S&P style large cap. Taxable account at Fidelity, VTI, same brokerage, two different answers. The portability difference is what splits them. I'd be doing you a disservice if I stopped without covering the other branches because plenty of you have accounts somewhere besides Fidelity. If you have a Schwab account, the path of least resistance is SWTSX, Schwab's total market mutual fund. If you have a Vanguard account, you have two choices. VTSAX is Vanguard's mutual fund version of the total market index, same CRSP US total market index as VTI, 0.04% expense ratio. The catch is the $3,000 minimum. So if you have less than $3,000 to start, just buy VTI directly. Both are good. VTI gives you the ETF tax efficiency we just talked about, and at $354.18 per share, you can buy a fractional share with most brokers if that math feels tight. One last thing for the holdouts who are now Googling, is something happening to my CRSP fund? You may have read that the CRSP indexes, the ones VTI and VTSAX track, are moving under Morningstar's Index Governance Framework on July 1st, 2026. Both CRSP and Morningstar have stated no methodology changes are expected. Different index providers do use slightly different rules for which small caps to include, but the long-run performance differences between CRSP, Dow Jones, and S&P total market methodologies are typically small. If you own VTI or VTSAX, you don't need to do anything. So where does that leave you? If you are a Fidelity holder watching this, your decision tree is now done. Tax-advantaged account, you want FZROX for total market or FNILX for large cap, both at 0%. Taxable account, you want VTI at 0.03%. Open the app this week, not next month, this week, and place the order. If the account is not funded yet, set up the automatic monthly transfer first and then the automatic buy. The single most useful thing you can do today is move from researching to automated. John Bogle launched the first index fund for everyday investors in 1976, so people would stop trying to outsmart the market and just own it. He was named one of the 4 investment giants of the 20th century by Fortune for that idea. The boring path is the math-correct path, and now you know the specific ticker that puts you on it. This is general education, not personalized advice. Before you make a final move on a taxable account or a rollover, talk to a financial advisor or a CPA who can see your full tax picture. They can catch the wrinkle a video like this can't. Now, the next question almost everyone hits after they pick the fund is which account to put it in to begin with. A 401k, a Roth IRA, both? And the answer hinges on a piece of math that most retirement calculators get wrong because they hide one number from you. That is the next video. If you stayed with me this far, click that one next. It changes how you should think about every dollar you contribute from here on out.